Welcome to this episode of CEO Perspectives, a signature series by the Conference Board. CEO Perspectives are conversations that take an objective, nonpartisan look at a range of subjects that matter most to business leaders. I'm Steve Odland from the Conference Board and the host of this series, and in today's conversation, we're going to talk about the state of the global economy. First, we'll look at our newly released data on the Consumer Confidence Index, and then we'll dig into the economic outlook for the United States.
You are listening to CEO Perspectives, a podcast by the Conference Board.
Joining me today is Erik Lundh, the principal economist here at the Conference Board. Erik, welcome.
Thanks for having me, Steve.
All right, so Erik, the new numbers are in regarding consumer confidence for May. What did we learn?
Well, Steve, we saw the overall consumer confidence index tick down for the month of May. It came in at 102.3, down from 103.7 the month prior. As far as the two components are concerned, the present situation index fell to 148.6 from 151.8, and the expectation index declined just a touch to 71.5 from 71.7. So really, the decline in the headline number was more associated with the present situation than it was with the expectations index. Now, one of the interesting things is, Steve, that the driver of the decline in the present situation index was actually associated with some of the labor market readings. So the consumers that we surveyed this period said that they were seeing somewhat of a softer labor market environment than they had previously. On the expectation side, that reading still remains below 80. 80 is a critical threshold for this index. Anything underneath that value usually indicates that the consumers are looking down the timeline a bit and expecting a recession. In terms of what's happening across ages and incomes, we've seen pretty broad declines over the last 3 months, regardless of where you are within those categories. But the May reading actually saw a notable decline among consumers over the age of 55.
Okay, so let's pause and go back a little bit here. Just to remind our listeners, the Consumer Confidence Index is made up of these two components that Erik has talked about. It's how are they feeling about the current situation or the present situation index, and then what do they think is going to happen in the next 6 months? Now, if you look back, Erik, over the past, half a dozen of these monthly indices, it was reversed. People were more worried about the future and, more sanguine about where they were. This is a little bit of a flip, isn't it?
Well, so their pessimism, consumers' pessimism about the future remains. It hasn't changed much, according to the index. It's still dour. They're still expecting a slowdown or a recession in the future. But what I think is different now is that we're seeing, for really the fourth time out of the last five readings, that the present situation, their outlook about what's happening now in their day-to-day lives is starting to decline as well. So in some ways, the experiences of the U.S. consumer are starting to really match gradually their expectations about the future, which of course means that the recession that they're expecting may be coming down the alley relatively sooner.
Yeah, and so we at the Conference Board have been forecasting the U.S. to go into a mild recession here in the second half of 23. Is that still your forecast?
It is. We could start to see GDP dip into negative territory as soon as this quarter. Our current forecast has it at minus 0.6, and we're expecting to see a contraction run through the end of the year. Okay,
so the fact that consumers are getting a little pessimistic here, and that reading below 80 suggests that maybe we're just about there.
I think it's certainly a possibility. We did have a fairly strong consumption reading come out on Friday of last week for the month of April. So that's a bit lagged, of course. It doesn't really line up with this May reading of consumer confidence. But I think we're going to see a situation where the U.S. consumer really starts to buckle under the weight of high inflation, high interest rates, and we really start to see consistent negative readings in terms of consumption.
Yeah. Now, during the pandemic, there was a lot of stimulus and consumer balance sheets were kind of replenished there by the government assistance. that's pretty much run off now, hasn't it? And people are now relying more on their credit cards, and so you're seeing consumer debt increase. Is that all fair?
That's partially true. There was a Fed paper that came out last year that actually tried to do some estimates in terms of how large the pandemic excess savings wave was and how much was sort of left in the tank from that. We worked at the Conference Board to try to update some of these models that they produced through the first quarter of this year. And there is still some gas left in that tank, but not nearly as much as what they had in their bank accounts, consumers, that is, in 2022.
Yeah. So basically people are kind of running to the edge of their money. They're not feeling flush with cash. But gosh, Erik, I mean, all you have to do is go to the grocery store and look at those prices, or go to the gas station and look at those prices. And, you just start scratching your head, don't you?
It is. It has been a very big issue and a prolonged issue for quite some time now. The only good news, if you want to call it that, is that the rates of some of this inflation that we're seeing has started to cool. It's not quite as dire as it was last year. And we're hopeful that those numbers will gradually ebb down over the course of 2023 and into 2024. But still, the Fed has a target that they're trying to get inflation to. That target is 2% year-over-year inflation. We don't think that's something that's going to be achieved until, at the very best, the end of 2024.
Well, and, that suggests that depending on what happens here, with the debt ceiling and all sorts of other things, the Fed may continue to raise interest rates.
So we have forecast one more 25 basis point hike in June. And then we're currently expecting the Fed to pause rates and to keep them high through the end of this year. Markets in recent months have been expecting the Fed to kind of buckle under the weight of an economic slowdown and reverse course and start to cut rates. But we're not really expecting that to happen until sometime in mid-2024, most likely.
Yeah, and then it'll probably be a gradual reduction, so that'll take some time. But this is an interesting time. And you mentioned the 55 plus reaction, and those people now 55 plus is a big band because it's 55 till end of life essentially. So you have some people who are working and some people who are retired. A lot of retirees in that group and who are on fixed incomes. And so inflation really hurts those folks.
No, absolutely. They are certainly a demographic that are suffering under the weight of inflation. One of the other things that came to mind when seeing these data on the 55 plus is that with the threat of a debt ceiling crisis where Social Security checks don't get sent out and Medicare money is frozen up, that would be the group as well that would take, the brunt of that kind of a situation on the nose. So there may be certain elements of concern surrounding the debt ceiling negotiations that really weighed on the 55 plus group.
Yeah, and even if they get paid later, a lot of folks live month to month or check to check on their expenditures. But we have to point out that these data were collected. The surveys were all done before there was any resolution on the debt ceiling. So a lot of angst and not a lot of light at that point. So, this downturn could be temporary to the extent that the debt ceiling weighed, but you still have the slow reduction in the rate of inflation, and that's going to continue to weigh.
No, that's right, Steve.
Yeah. What about so you mentioned the jobs, a weakening job market. Is that just a tiny little weakening? Because you still see historically low unemployment, don't you?
You do. Unemployment is still extremely low. The labor markets are extremely tight. But according to the survey, the respondents reported that easiness in which they're able to get a new job declined. And those who were asked about, is it difficult to find a job, that ticked up a little bit. So both a decline in responses about how easy it is to find work and a increase in difficulty in finding work among certain people as well.
Yeah, but you still have now the number of job openings have come down. I think at one point it was 11 million. I think we're down into the 9.5 million range, but that's still a lot of open positions.
And it absolutely is. And it's our expectation that this recession is going to be interesting and different from many others. A job-full recession is something that we're expecting. We do believe that the unemployment rate is going to rise. We expect it to maybe rise by about a percentage point, peaking sometime towards the end of 2023 or early 2024. But even in sort of pre-pandemic context, the unemployment rates that we're forecasting, 4.5% or so, are still pretty decent, especially when you pair it with the fact that we're expecting to see the economy contract. So the economy is, even though the labor market's going to loosen up a little bit, it's still going to remain tight in the downturn. And it's going to be something that I think companies have to grapple with for many years, given sort of demographic and structural issues.
Yeah, and 5% used to be the number that economists viewed as full employment, and so what you're saying is, the worst, at the worst, forecasted, of course, we're talking about something in the 4.3 to 4.5 range. So that's still pretty good, as you point out. So the other thing is, you typically at this point going into a recession don't see 9.5 million open positions, and so the easiest position to cut if you're a CEO is the position that's not filled, right? So just because just on the flip side, playing devil's advocate, it could be that you end up, to the extent that you can redeploy skill sets and so forth, it could be that you end up eliminating open positions first and not affecting quite as many people. So that's another option, isn't it?
It is absolutely. We get the jobs report out this coming Friday, so we'll get a little bit more information about what the latest pulse of the labor market looks like.
Now, you do forecasting on goods and services, which some people don't think is all that interesting in certain periods, but in this period it is interesting because of the way goods and services behaved during the pandemic. What are we seeing now?
Well, so you're right, Steve. During the pandemic, there was a big pivot in terms of U.S. consumption habits. Typically, U.S. consumers are much more focused on services, but over the course of the pandemic period, they were afraid to go out. They were afraid to go to restaurants and go on vacation because they were afraid that we're going to get sick. As a function of that, we saw a big spike in goods spending. That has been reversing over the last year or so. The sort of growth rate seen in goods has been weaker, but services have been rebounding. And so I think, our expectation is that that's going to sort of fizzle out as well, again, as inflation and interest rates and a looser labor market sort of put a little bit more pressure on consumer pocketbooks.
We're talking consumer confidence in the U.S. economy with Erik Lundh from the Conference Board. We're going to take a short break, and we'll be right back.
What does the future of work mean for your employees? How will your company navigate ESG? Will there be a global recession? At the Conference Board, our experts translate the latest research and economic analysis into insights and real-time problem solving for your organization. Membership at the Conference Board provides your team with an assortment of knowledge from economics, marketing and communications, ESG, public policy, and human capital. As a member, you'll have access to our center experts, member-exclusive events, data and benchmarking tools, and peer sharing that will help you understand the present and shape the future. Consider becoming a Conference Board member today by visiting www.conference-board.org.
Welcome back to CEO Perspectives. I'm your host, Steve Odland from the Conference Board, and I'm joined today by Erik Lundh, our principal economist here at the Conference Board. Okay, so let's turn now, Erik, to the U.S. economic update. You do the forecasting for this each month. What are you seeing, in terms of the GDP going forward?
So as I mentioned at the top end of the podcast, we're expecting a growth rate of about minus 0.6% in the second quarter of this year. And we're anticipating that that slowdown or that contraction intensifies over the course of the second half of the year. Right now, we're looking at a minus 1.6 reading for the Q3. and then a minus 1.2 reading for Q4. Looking a little bit further around the corner into 2024, we are expecting the economy to reverse course and start to grow again, but gradually. We're only expecting under 1% growth for Q1, and we're really not expecting to see the U.S. economy to get back to sort of its more stable 2 to 2.5% growth rate until the second half of 2024. So, the story here is a sort of shortish and shallowish recession over the course of this year, and then a gradual emergence into sort of pre-pandemic normalcy in terms of growth rates, but not until the tail end of 2024.
It always is interesting to the layperson to listen to economists talk about growth rates that are negative. It's like, well, isn't growth supposed to be positive? And so it was either growth or decline. But it is the way that, technically we talk about it. But these numbers, these declines that you're talking about are not, you're talking about a relatively shallow and short recession versus what we've experienced historically. So they're, yes, it's down a little bit, but, there's no looming disaster here.
That's right, Steve. If you want to even try to compare it to the recession that we had at the onset of the pandemic, the growth rate at that point was negative 30 some odd percent. So a massive contraction.
That's a lot.
Yes.
That's a lot. And then the one before that was the Great Recession, and that was a big decline as well. Not 30%, but that was a big decline as well. So this looks like it's manageable and it's job full, as you said, which I don't think we've ever seen before. So this is really a unique situation.
It is a unique situation. But the fact of the matter is that the growth rates that we've been experiencing over the last year or so, year to 2 years following the rebound, following that massive recession, aren't sustainable. The Fed has increased interest rates by 500 basis points in just over a year. We have quantitative tightening taking place. We have both consumers and CEOs telling us that they're expecting to see a recession on the horizon. So, in a lot of ways, what I'm expecting is sort of a bookend to the volatility that we've had over the pandemic period. It started with a huge recession in 2020, and hopefully a mild recession in 2023, and then we can start to maybe get back to some degree of normalcy in terms of the economy starting next year.
So, essentially, this recession is unlike, I guess, maybe any other, in that it's driven mostly by the Fed and its desire to cool the inflation, which, of course, it has to do. It's the role of the Fed, and you don't want high levels of inflation. That's really bad for people, as we've discussed. So therefore, they've got to do this. And so this recession, it's not a financial crisis. It's not a banking crisis. It's not a fundamental, there's no war. There's not, it's not those kinds of things that have happened in the past. And so therefore, you'd like to believe that as soon as inflation starts coming down into the range that things will start feeling a lot better. So therefore, what are your forecasts for inflation?
So, as I mentioned earlier on, it's not going to be a touchdown, spike the ball kind of situation. There has been progress in terms of the severity of inflation. If you look at the month-over-month readings, they've come down quite a bit from where they were a year ago. But it's going to be slow progress. If you look at, for instance, the core personal consumption expenditure, which is actually one of the Fed's preferred metrics for gauging inflation, it's been moving fairly sideways for the last 6 months or so. So there hasn't been a ton of progress there. So our expectation is that we'll probably see something along the lines of 3% year-over-year inflation by the end of this year. But it'll take a full year beyond that to push it down an additional percentage point to that 2% target.
So that means for the full year of 23, because you're talking about 3% by the end of the year. But so for the full year of 23, it should be closer to 6% for the year?
Yeah, that's about right, Steve.
And then if you just enter the year in 24 at 3 and you end at 2, it's got to be around 2.5%.
Yeah, just over 2%.
Yeah. So okay, so 24 sounds pretty normalized. I mean, the Fed ought to ought to be relaxed, once it starts to hit, mid twos or so, right? But
I think so. Yeah, I think, policy rates are in such restrictive territory right now that I think the Fed might be willing to dial down the Fed funds rate before it gets to that 2% number. Once we potentially get down sub 3%, getting down maybe around 2.7, 2.6, the Fed might be willing to maybe start to loosen policy a little bit. It's still going to be tighter than what it was during during the pandemic, of course, and even what it was prior to the pandemic. So maybe something along the lines of 4% or something like that, as opposed to where it is now.
We mentioned the inflation effect on prices for consumers, but it also, of course, hits the cost of debt for consumers, whether you're talking credit cards or you're talking mortgages. And we are seeing the housing market slow down, although, as you've pointed out, in everything that you've written, there is a lag between the, mortgage rates hitting the housing market and then the housing market trailing, going into leases. So the leases lag by 12 to 18 months. And so you've got that still coming down for the next year. So it's which means that leases continue to go up, but the rate goes down. So yeah, I think it's going to feel to consumers, unless I'm wrong, like they're still being pushed, even though the top line numbers might look better.
I think so, Steve. It's still going to be eroding at earnings, and you're still going to be paying more for your groceries, your electricity bills, et cetera. But it's just not going to be as severe an increase as what we saw, in 2022 and 2021.
And this is why you look so closely at the Consumer Confidence Index, because confidence is driven by, their lot in life, which is, how much can they afford, what is their family experiencing and what the job situation is. So, and that in turn affects spending. And that's important because consumer spending is nearly 70% of the U.S. economy. So
that's right.
All of this is kind of tied together. All right. So we don't really know what the resolution of the debt ceiling discussions will be as we talk right here. It looks like there's a tentative deal. That hasn't been ratified. There's no vote yet at this point. So it still could be choppy waters ahead. But let's assume that it gets resolved here and, we return to some normalcy. Would you expect consumer confidence then to rebound a bit?
It might a little bit. If it's difficult to say exactly. So we did among the survey respondents who filled out or commented on what their top concerns were, only about 2% actually listed the debt ceiling issue as one of their top concerns. Some of the other ones that are really top of mind for them are jobs, interest rates, and higher prices, all of which we've kind of already talked about here. So I don't think that the debt ceiling crisis or potential crisis has had a really strong and broad impact on the consumer confidence number. But I think that it may be partially responsible for the hit that we saw in that 55 plus category. That having been said, any kind of a resolution to this is certainly not going to hurt consumer confidence. It will best have no effect, it will at worst have no effect, and at best have a little bit of a positive impact on consumer sentiment.
Kind of a leading indicator of predictions on things like the debt ceiling or whatever's happening in the financial markets is the stock market itself. And even though the stock market's drifted down a little bit, it has been relatively calm about this whole situation, suggesting that the expectations are that there'll be some sort of settlement and it should be okay. Any insights there that you could share with us?
I mean, I'd just say that the stock market has been through this before. This isn't the first of its kind of potential crisis. So I think over the years and through experience, a lot of investors have learned how to interpret what's happening. I think the current negotiations and the current sort of crisis, if you will, has been maybe a little bit more severe, a little bit more concerning than ones in recent history. But you're right. the markets are reacting to positive news about negotiations or discussions over the last couple of weeks. But given the severity of what could happen if the U.S. actually did default, the markets have been pretty mature and maybe pretty understanding about all of this.
Yeah, and both sides have said, we don't want a default, we don't expect a default. So, the inkling here is that that we're just negotiating. And by the way, the experience has been in 7 of the last 10 debt ceiling increases, there have been negotiations. So you're right. This isn't their first experience with it. Erik, anything else that you want to share with us in these data that we haven't talked about?
I think we've covered things fairly broadly. One other actually tidbit that I thought was interesting was on consumer spending intentions. So the consumers were asked them, what are you intending to spend your money on looking ahead? We did see some interesting developments there. Consumers have reported that they were expecting to purchase a home over the next 6 months. That was about flat, didn't change too much from April. But there was an increase in terms of the number of consumers who reported that they were going to be buying a vehicle or sort of a larger sort of appliance or something like that over the next 6 months, which was a little bit unexpected. And then finally, in terms of their intentions to go on vacation or to travel, there we actually did see a fairly sizable deterioration. U.S. consumers said that they maybe weren't looking to spend on flights and hotels and vacations to the extent that they had been planning to in previous readings of the Consumer Confidence Survey.
Well, thank goodness for that, because every plane that I've been on recently has had every seat full. All the hotels are full, and I'm told that cruises are booked out through 2027. So I think travelers could use a little bit of relief here. So I don't know if it's going to happen or not. One thing that I saw in the data that we haven't talked about is, there were huge consumer confidence declines in California, New York, and Illinois. Folks in those 3 states are not happy people right now.
Yeah, that's right, Steve. The vast majority of the various regions that we measure did see downturns, but some were a little more extreme than others.
California, New York, and Illinois. Okay, Erik, thanks for joining us today.
It's my pleasure, Steve.
And thanks to all of you for listening in to CEO Perspectives. Every week, I'll be joined by a prominent thought leader to provide insights on the issues of our time. We'll cover the leading topics in geopolitics, economics, public policy, and more. Please share CEO Perspectives with your colleagues, with your friends, with your favorite economists. I know they're going to want to listen. I'm Steve Odland, and this series has been brought to you by the Conference Board.
You have been listening to CEO Perspectives, a podcast by the Conference Board.